Welcome back to Accounting Cave, episode 4 of our management accounting series. But before we continue, please subscribe, like, share the content, and press the notification bell so that every time I upload a new video, you get to be notified. In this episode, we are going to learn variance analysis. Let's start by understanding what's variance. Variance is the difference between the standard cost and the actual cost. The purpose of variance analysis is to control the activities of an organization more effectively. Variances highlight to management that everything has gone as planned. They highlight the problems and direct them to management attention. Variances are subdivided into material cost variance, there is the labor cost variance, and there is the overheads variance. In overheads variance, we have the variable overhead, and we also have the fixed overhead. Variances may be favorable or unfavorable. Then unfavorable variance is also called the advance. When the actual cost is greater than standard cost, the variance is known as unfavorable or advance. On the other hand, when actual cost is less than the standard cost, the variance is favorable. So when the actual cost is greater than the standard cost, that's unfavorable. When the actual cost is less than standard cost, that's it's variable. Let's start with material cost variance. Material cost variance is the difference between the standard direct material cost of the actual production volume and the actual cost of direct materials. So, the to get material cost variance, this is the sum of material price variance and the material usage variance. Let's have an example to calculate material cost variance. In our example, it says the material standard for 1 unit of product wire is 3 kgs at 5 shillings per kg. 14,000 kgs was used at a cost of 84,000 shillings and 4,000 units were produced. Calculate the material cost variance. Let's now calculate after reading our example. First, we have to calculate material price variance, which is given by actual price multiplied by actual quantity minus standard price multiplied by actual quantity. In our example, our actual price and actual quantity, it's 84,000 shillings because we are given cost which is price multiplied by quantity already, that has been multiplied. So our cost is 84,000 shillings minus our standard price is 5 shillings per kg. So that's our standard price. So 5 multiplied by our actual quantity, actual quantity, uh, which is 14,000 kgs. So it's 84,000 minus 5 multiplied by 14,000. So we get 5 multiplied by 14,000, which is 70,000. So it's 84,000 minus 70,000, we get 14,000. Remember, we said when the actual cost is greater than the standard cost, that's unfavorable or adverse. And when the standard cost is greater than the actual cost, that's favorable. So in our first, that is material price variance, the actual cost is 84,000, which is greater than our standard price, our standard cost, which is 70,000. So it will be 14,000 adverse or unfavorable. Let's go to our second one, which is material usage variance. Material usage variance is given by standard price into actual quantity minus standard quantity. So standard price into actual quantity minus standard quantity. So our standard price we had it, which was 5 shillings. So it's 5 into actual quantity is 14,000 kgs. So we have 14,000 kgs. We don't have yet the standard quantity. So standard quantity, you can see as I've done it on the side, that standard quantity is equals to uh, 3 multiplied by 4,000. 3 is the standard quantity that we have at 5 kgs per kg. So we have 3 kgs multiplied by the total units which were produced 4,000. So we get the standard price, the standard quantity, it's 12,000. So it will be 5 into 14,000 minus the standard quantity which we've gotten, it's 12,000. So we get 5 into 2,000. So 5 multiplied by 2,000, it will be 10,000. Remember, as we've done on the material price variance, that wherever the actual quantity, the actual cost is greater than the standard, we say it's advance. So we have 14,000 which is greater than 12,000, so that automatically it's advance. So we will have 10,000 advance. So now, going back to our example, we are required to calculate the material cost variance, which were required to calculate the material cost variance. So we say material cost variance is equals to material price variance plus material usage variance. So we get 14,000 advance plus 10,000 advance, which we get 24,000 advance. And that's how to calculate material cost variance. Our second subdivision of variance analysis is the labor cost variance. This is the difference between the standard direct labor cost and the actual direct labor cost. Labor cost variance is given by the sum of labor rate variance plus labor efficiency variance and idle time variance. Let's start with labor rate variance. This is the difference between the standard and the actual direct labor rate per hour for the total hours worked. It is calculated as actual rate multiplied by actual hours minus standard rate multiplied by actual hours. The second type of labor cost variance is the labor efficiency variance. This is the difference between the standard hours for the actual production achieved and the hours actually worked, valued at the standard labor rate. It is calculated as standard labor rate into actual hours minus standard hours. The third one under the labor cost variance is the idle time variance. This may arise when some wages are paid for idle time. This variance is always advance. So that means that the actual cost is always greater than the standard cost. So that's why it's always advance. Idle time variance is calculated as idle time multiplied by standard rate. As we've done in the material cost variance, an example, let's also do an example in labor cost variance. Our example says that calculate labor cost variance from the information below. Standard rate per hour shillings 10. There is the standard time per unit, 2 hours. There is the time worked, 4,250 hours. Time paid, which time paid is 4,326 hours, which has been paid a total of 42,500 shillings. And then there is production achieved, 2,180 units. Let's start by calculating labor rate variance. So labor rate variance is given by actual rate multiplied by actual hours minus standard rate multiplied by actual hours. We have actual rate and actual hours. We've been given the cost already, which is 42,500 shillings minus standard rate, which is 10 shillings per hour, multiplied by actual hours, which is 4,326 hours. So it will be 42,500 minus 10 multiplied by 44,326. We get 43,260. So which will give us 760. That's the difference. But remember, we said when the actual cost is greater than the standard cost, it's adverse. And when the standard cost is greater than the actual cost, it's favorable. In our example, in this one, in labor rate variance, our actual cost, which is 42,500 shillings, is less than the standard cost variance, the standard cost, which is 43,260. And that's why we say it's favorable. So we will have 760 favorable. The next one is the labor efficiency rate, which is given by standard rate into actual hours minus standard hours. Standard rate, we have 10 shillings per hour into actual hours, it's 4,250. That's our actual hours. So I will say minus standard hours. Our standard hours will be 2, which is the standard time per unit, multiplied by the total units which have been produced to get the time, the hours which have been used to produce the units. So we say 2 multiplied by 2,180 to get 4,360. So it's 10 into 4,250 minus 4,360. So it's 10 into 110. The difference between 4,250 and 4,360 is 110. So it's 10 into 110, which will get 1,100, which we say it's favorable because the standard hours are greater than the actual hours. So we say it's favorable. The third one in labor cost variance is the idle time variance. Idle time variance is given by standard rate multiplied by idle time. Uh, in this one, we have the standard rate as 10 shillings per hour into our idle time is the difference between the time paid and the actual time worked. Time paid is 4,326 hours, and the actual time worked is 4,250 hours. The difference is 76 hours. So it will be 10 into 76, which gives us 760. We said that idle time variance is always in advance, so it will be 760 advance A. That's A. So our labor cost variance will be equal to labor rate variance plus the labor efficiency variance plus idle time. variance. In our labor rate variance, we got 760 favorable plus labor efficiency variance, we got 1100 favorable plus idle time variance, we got 760 advance, which will give us, if you add the favorable and the advance, will be advance, it's negative, so it's minus, so it will give us 100 1100 favorable. Our third type of variance is the variable overhead variance. This is the difference between the standard variable overhead cost and the actual variable overhead incurred. Alternatively, this is the difference between the actual variable overheads incurred and the variable overheads observed. Variable overheads variance is equals to variable expenditure variance plus variable efficiency variance. Let's start with the variable overhead expenditure, which is given by actual variable overhead minus variable overhead absorption rate multiplied by actual labor hours. The second variance in our variable overheads is the variable overhead efficiency variance. It is calculated as variable overhead absorption rate into actual hours minus standard hours. Let's do an example. Our example requires us to calculate the variable overhead variance from the given information, which is standard cost per hour 8 shillings, standard time per unit 5 hours, actual production 220, labor hours worked 1200 hours, and cost incurred 10,300 shillings. Let's calculate our example. First, we calculate the variable overhead expenditure variance, so which is given by actual variable overhead minus variable overhead absorption rate multiplied by actual labor hours. Our actual variable overhead, we given the cost incurred is 10,300 shillings, so it's 10,300 shillings minus our variable overhead absorption rate is 8 shillings, so 8 multiplied by actual hours, which is 1200 hours, so we get 10,300 minus 8 multiplied by 1200, it's 9,600, so 10,300 minus 9,600 is equals to 700, and because the actual cost is greater than the standard cost, we say it's advance, so it's 700 advance. Our second one is the variable overhead efficiency variance, which is given by variable overhead absorption rate into actual hours minus standard hours. Our variable overhead absorption rate is 8, which is 8 into actual hours. We have 1200 hours. To get our standard hours, we'll multiply the standard time per unit multiply by the actual production, which will give us 1100. So it will be 8 into 1200 minus 1100, which will give us 100, which is 8 multiplied by the 100. We get 800. And because our actual hours are greater than the standard hours, we say it's advance. So the variable overhead variance will be equal the variable overhead expenditure plus the variable overhead efficiency variance, which will be 800 advance plus 700 advance will be 1,500 advance. Our fourth subdivision of variance analysis is the fixed overhead variance. Remember when we were subdividing, as we started the topic, we said we have three types. Like we have the material cost variance, the labor cost variance, and the overhead variance, where we said overhead as the variable overhead and the fixed overhead. So we've tackled the variable overhead. Now we are in fixed overhead variance, which is the difference between the standard cost of fixed overheads absorbed in the production achieved whether completed or not, and the fixed overheads attributed and shared in that period. Fixed overhead variance is given by the sum of fixed overhead expenditure variance and fixed overhead volume variance, which you can see we have fixed overhead variance is equals to fixed overhead expenditure variance plus fixed overhead volume variance. Let's start with the fixed overhead expenditure variance, which is the difference between the budget cost allowances for production for a specified control period and the actual fixed expenditure attributed and shared to that period. It is calculated as actual expenditure minus the budgeted expenditure. The second type in the fixed overhead variance is the fixed overhead volume variance, which is uh, the difference between the standard cost absorbed in the production achieved whether completed or not and the budget cost allowances for a specified control period. Fixed overhead volume variance is given by standard cost into actual production minus budgeted production per unit. Let's have an example of to calculate the fixed overhead variance as given in the screens. Calculate the fixed overhead variance from the information given. Standard cost per hour, which is 15 shillings. We have the standard hours per unit, 2 hours. We have the budgeted production, which is 400 units. We have the actual production, 360 units. Labor hours worked, which is 780 hours. And we have the cost incurred, which is 13,800 shillings. Let's give a solution to our example. Let's start by calculating the fixed overhead expenditure variance, which is given by the actual expenditure minus budgeted expenditure. The actual expenditure will be given, that is 13,800 shillings, minus the budgeted expenditure, which will calculate the budgeted expenditure, which will be the standard hours per unit multiplied by standard cost per hour multiplied by budgeted production. It will be the standard hours per unit is 2 hours multiplied by standard cost per hour, which is 15 shillings, multiplied by the budgeted production, which is 400 units, which will give us 12,000. So it will be 13,800 minus 12,000, which will get 1,800. And because the actual cost is greater than the standard cost, that will be advance. So we will have 1,800 advance. The second one in the fixed overhead variance is the fixed overhead volume, which is given by standard cost into actual production minus budgeted production per unit. In our example, the standard cost is 30. Standard cost is 30, which will the 30 will be calculated as standard cost per hour which is 2, multiplied by standard hours per unit, which is standard cost per hour, which is 15, and multiplied by standard hours per unit, which is 2, to get the standard cost, which is 30. So it will be 30 into actual production is 360 units minus the budgeted production, which is 400 units. So the difference will be 40. So it's 30 multiplied by 40 to get 1,200. And because the standard cost is more than the actual cost, we say that's favorable. So it will be 1,200 favorable. So our fixed overhead variance will be fixed overhead expenditure plus fixed overhead volume variance, which will be 1,800 advance plus 1,200 favorable, which will give us 600 advance. That's all about variance analysis. If you have any question, any comment, please comment in the comment section. And if you have anything you want us to cover more, please comment in the comment section. And for now, enjoy the variance analysis. And thank you for watching this video. Till next time, continue subscribing, continue liking, and press the notification bell so that every time I upload a new video, you get to be notified. And for now, we say bye.